In trading, the ones who earn are not those who click the most, but those who know when it actually makes sense to click. Today, we'll have a short trading session on pocket option. Candles' bodies are getting smaller, the impulse is losing strength. The candle moves down, and we close the trade in profit. Post-trade analysis, what beginners ignore. And the candle closes confidently upward. Second trade, plus dollars. Why I stopped here? A lesson in discipline. Today, I don't just want to show you trading, I want to walk you through the thinking process behind every trade I take. You often ask me, why do you take so few trades in a session? You could be opening way more. The answer is very simple. In trading, the ones who earn are not those who click the most, but those who know when it actually makes sense to click. Today, we'll have a short trading session on pocket option, but with a focus on analysis. I'll show you how I make decisions, what exactly I look for on the chart, which signals I trust, and which ones I completely ignore. If you want more breakdowns in this style, check out my Telegram. That's where I explain the market as a system and as a calculation, not as a random luck. Let's get started. Preparation. Reading the chart as a structure. We open pocket option. Chart type, candlesticks as always. Payout 92%. Volatility medium. I set the time frame to 30 seconds. That's my balance between speed and structural clarity. Before I even think about opening a trade, I do what most beginners skip. I observe. I look at the last 10-12 candles. Candles' bodies are getting smaller, the impulse is losing strength. Wicks are growing. The market is searching for a reversal. Candles are getting tighter. The oscillation is increasing. The angle of movement is flattening. The trend is slowing down. This isn't magic. It's just market logic, shown on a chart. When momentum weakens, the move slows down. When the wicks get longer, it means the pressure in the market is changing. The market behaves same way. Trade number 1. Entering on structure, not emotion. First trade size, $50. What I see. Price is moving up, but every new candle is printing a long upper wick. That means buyers are still pushing, but sellers are starting to dominate. Classic sign of a local overextension. I enter down. While this trade is open, I want to explain something important. Beginners think it's all about guessing the point. A professional focuses on conditions, not on a single movement. Price never reverses. Out of nowhere, it always shows slowdown first. And the candle moves down, and we close the trade in profit, $46. Not because we got lucky, but because the structure was speaking clearly. Post-trade analysis, what beginners ignore. After every trade, I always review why it worked. This trade was profitable for 3 reasons. Upper wicks, a clear sign the uptrend is weakening. Narrow wick candles, the market is losing momentum. Flatter trend angle, buyers are exhausted. Most people ignore this, but this is the foundation. I don't analyze trades just for statistics. I analyze them to understand repeatability. When a reaction repeats, it becomes a pattern. When pattern repeats, it becomes a strategy. That's why experienced traders never rush. Trade number 2. Entering with impulse after a correction. Next trade size, $80. After a drop, the market almost always attempts a bounce, a mini correction. Here is what I see. The candle flips direction. The lower wick is much longer than the previous ones. The green candle body is dense and clean, not choppy. The speed of the rise is steady, not spiky. That's a good sign buyers are trying to build an impulse. I enter up. While we wait, a quick tip. Never look for a 100% signal. It doesn't exist. There are only conditions that increase probability, just like in finance. If the conditions are right, the move will follow. If they aren't, the result will be weak. And the candle closes confidently upward. Second trade, plus $74. Second analysis. Why waiting for confirmation matters. Beginners make the same mistake. They see a green candle, instantly hit up. See a red candle, instantly hit down. But an experienced trader waits for confirmation. The lower wick locks in buying pressure. The candle direction confirms the impulse. And the shape of the candle shows whether there is noise in the move. It's like watching a reaction and checking its state before you add a catalyst. Without confirmation, you are not trading analysis, you are trading emotion. Trade number 3. Fewer trades, more logic. Next trade size, $120. At this size, I never enter impulsively. First, I watch how the structure behaves. I note a few key signs. The last green candle are getting shorter. Bulls are losing pressure. Upper wicks are growing. Sellers are actively pushing price back. The angle of the up move is flattening. The trend is running out of steam. Candle bodies are narrowing. The market is preparing for a shift. This is a classical sign of a local exhaustion and uptrend. In finance, this is called an overheating point, when the market can no longer sustain the rise and start to cool off. I wait for one more candle. It pushes slightly higher than the previous one, then instantly prints a long upper wick. Sellers immediately knock the price down. That's my signal. I enter down. While the trade is running, let me explain why entering against the tired trend often makes more sense than trying to push it higher. When the market moves up on its last impulses, it does it slowly, nervously, with long wicks. But when it reverses down, it often does it fast, clean, and with conviction. That's pure physics. Buyer pressure falls, seller pressure rises, the reaction changes direction. And the candle confidently breaks the previous low and closes below our entry. Third trade closes in profit, $110. Not guessing, not intuition, just the market reacting to a loss of momentum. Why I stopped here? A lesson in discipline. And this is where the difference shows between a trader and someone who just likes to gamble. I could keep going. Mood is good. 3 wins in a row. But I can see the market entering a noisy phase. Wicks are getting longer, impulses are slowing, structure is breaking up, candles bodies are shrinking. It's like the market after a strong impulse. It enters a zone of instability where the direction can change. If I can continue, the probability of a losing trade increases sharply. So I do what a professional does. I stop. That's the hardest action in trading, but also the smartest. Today I showed you something important. You can open just 2 or 3 trades, and that can be enough if the analysis is solid. There is no point in clicking 20 times in one session. It doesn't increase your chances of earning. It increases your chances of making mistakes. I want you to remember 3 key ideas. Number 1. Spend more time observing than trading. Number 2. Analyze every trade, not just the result, but the reasoning. Number 3. Stop when the market changes character. If you want more breakdowns like this, no rush, no chaos, just logic and structure, check out my Telegram. There, I explain the market as a system of calculations, not as something random. See you in the next video. And always remember, trading isn't about clicking, it's about thinking.